Hi, I'm John Hull. I teach in the business school at the University of Toronto. It's called the Rotman School of Management. And my area of expertise is derivatives and risk management. Well, it's, it would be nice to write a book about something which never changed. Let me think. I mean, if I wrote a book about calculus, for example, that sort of seems to stay much the same one year to the next. But my book actually was I don't know whether you ever saw the first edition of the book, but that was a pretty thin volume. It was, about 300 pages. It's now grown to 800 pages. And it's tried to keep pace with all the changes we've seen in the derivatives markets. Recent changes, of course, have been the ones I've just been outlining, the move to central clearing parties and the over-the-counter markets becoming more like exchange-traded markets. So what's next? I think some of the more exotic products that we've seen in Europe and North America are disappearing from the market. I think there's a tendency for quants who are highly mathematically well trained to move from pricing really exotic instruments to moving into risk management and worrying about how we can quantify counterparty credit risk, how we can quantify market risk, and that sort of thing. I think we will see, what derivatives are all about, of course, is transferring risk in the economy. And so I think and people who work in the derivatives area are very creative, so they can continue to look for new risks to transfer. I wouldn't like to speculate on what those risks are, but I'm sure we will see development of risks. Robert Merton actually had an interesting idea, which is that countries should trade derivatives, not just companies, so that if country A, is exporting oil but importing some other commodity, then there's a natural derivative transaction that company could enter into to protect itself against changes in the relative prices of oil and whatever the other product is that it's importing.